So investor behavior, they say, is one of the largest determinant of how much returns will an investor actually generate over the long period of time. Perhaps even more important than what exactly are you buying and how long are you holding it. And regarding this subject, none other than an expert joining us on the chat today, Steve Wendel, who is coming down from Chicago. He's a head of behavioral science at Morningstar in Chicago, is here with us to chat about this subject. A lot of Indian investors are increasingly following behavioral patterns in order to improve their own performance in the market. Steve, wonderful chatting with you today.
Thanks so much for having me. It's a pleasure.
So Steve, let's start by understanding why up till now, despite of the fact that investing has developed, several global markets are now in the very large sized, and the entire subject of investing is very well known. But investor behavior and how important could it be in generating better returns is still underrated globally.
Sure. So we find that there's been a tremendous growth over the last 10 years, an appreciation that psychology matters, just like you said. A variety of studies that have come out and have shown quite rigorously that the single most important factor is our psychology and how we behave, that the details of asset allocation matter less. And so it's with this new research and this growing appreciation that we're seeing just a tremendous growth in the field.
As they say that stock markets are the only place when the prices actually are discounted and become attractive, that the buyers flee the scene, unlike any other particular segment of consumer category. And Indian markets are undergoing a deep correction right now, almost 8-9 months. And this is exactly what has happened, that people are shunning the market. So what would you like to tell our Indian viewers who are also investors?
So I would say, remember what matters to you. The goals, why you're investing, what you hope to do for your family, for yourself, for your society. Those things rarely change. Sure, the markets go up and down. But if you look at what really matters, if you're still on course, stay the course.
I was actually observing your presentation as well, and people are quietly listening to it. If you could give us some color on some of the biases which investors tend to have, which holds them back from having a superb performance of their own portfolios.
Sure, so there are quite a few, and one of which I'll just build upon what you said. People shunning equities as the market goes down. One of the reasons we see that is herding behavior. So when we don't know what to do, especially when we're not experts in the field, right? We look at what other people do. It's a natural shortcut that our minds take. Unfortunately, in investing, if you look what other people are doing as they're leaving the markets, you leave too, and you can get in a lot of trouble. So that's one of the challenges. The other challenge is what's known as recency bias. That if you see that the market has just dropped over the last 9 months, right, 20%. If you don't know a lot about investing, right, even if you do, a natural thing to assume is, well, what just happened is what's going to happen again. So if you know that the markets are going to drop another 20%, it makes perfect sense to leave right now. Unfortunately, that's not how investing works. So those are two of the big challenges, two of the big biases that people face.
The other thing which is spoken about by some of the legends of investing is that money is actually not made in buying or selling. The big money is actually made in doing nothing and sitting over your investment for a long period of time. But at the same time, investors tend to have do something syndrome, that they have to keep doing something in order to improve their performance. How should one fight that urge?
That's great. So so as behavioral scientists, we study these ideas. We call that action bias. That especially when things are volatile or going crazy, you feel the need to take action, which often isn't a great idea. So what do you do about it? Well, it can be very difficult just to say, remain calm, remain calm, remain calm, right? Because that's how our minds are wired. So instead, you can write out the rules that you want to follow. And you are going to do something. You're going to view them and see, is this the time to act? Is this the time to act? That's one way, right? Another thing that you can do is create some portion of your portfolio that you'll take whatever action you need. You can try and time the market. Go ahead and try. It's very, very difficult, and I wouldn't advise it. But you have one small area where you do that, where if you panic, you'll take out of there. And that's your short-term bucket, and leave everything else untouched. So it's a mental accounting technique. Most of the money, long-term, a little bit of the money, okay, sure, you can respond, you can take that action in a way that's less damaging.
The other thing which we've actually observed in the market is that suppose an investor has got a hypothesis about a particular security, a particular stock, and the moment the price of that particular security or stock actually changes, the hypothesis also changes a whole lot. If the stock goes up 20%, you start liking it even more. If the stock falls 20%, you suddenly start questioning your own hypothesis. How can people, when they encounter this kind of situation, actually act rationally in your view?
So I fear that you were describing how I feel as investments go up and down, because this is how we're all wired. It's not there are those other people who are foolish. Rather, it's all of us as investors. And so what do you do about that, right? So it comes down to externalizing, to getting it out of your head so that you can see the hypothesis you had before, and you can see if you're changing it. There's a body of literature in behavioral science specifically about self-deception, about how easy it is for us to just fudge things. The solution often is just get it out of your head where it's difficult to lie to yourself and get it on paper.
You know, they say about the stock markets that stocks, be it whichever country we are talking about, over the long term, the certainty of making money is very high. The probability is very high if you get into good stocks or a basket of good stocks and sit for a long period of time. But the same stocks, the certainty of making money in the short term or the near term is very negligible. And people actually fall in that trap a whole lot. They know the stock is good, but they want to act, you know, every now and then, and the periodicity of action is very high. Whereas they know that the certainty is very high if they don't do anything. So how can one really, you know, fight this greed versus fear kind of a tug-of-war which happens in investors' mind all the time?
It's a great question. And part of the challenge is that we focus on what's vivid and immediate before us, right? So sure, we might in theory think long term, I'm in it for the long term, but I've got this opportunity right now. I want to act. And again, I describe myself. It's not other foolish. It's not other people. It's how we all are. So what do you do about that? Well, one way is to tie your hands, to make it difficult for you to fall prey to the short-termism, right? So one way is to lock in your investments and say, okay, advisor, I will only, we can only change these once a year. You can write a contract with them, you can make it an informal agreement. There are a variety of ways that stop you from giving into that. There's another fascinating study, I love this, that as people look at market prices more often, the more it warps their behavior. So the more they see the daily movements or the hourly movements up and down of what's going on, actually the more fearful and conservative people get, and the more they want to pull out. And so one technique is set a regular schedule for checking and avoid the ticker, avoid the up and down of the moment, and just see how you're doing, not how the market's doing in a moment.
So the two most important things you were to tell budding investors and you know our viewers as well, to curb their behavior or keep their behavior under check in a way to improve their overall portfolio performance over the long period of time, what would those two things be?
Sure, so I think we've touched upon them. The first thing I would do is to externalize. Write out your rules. As much as possible, write out the reason you do it, the enduring value you have, the goals you want to achieve, family, society, etc., right? Second, I would think, how can you create friction? How can you make it harder to take foolish action, right? How can you make it harder to stray from your path? There's a funny example in personal finance. So when I was struggling to pay off my credit card debts, you know what I did? I took my credit card and I literally put it in a bag, poured water in it, and put it in the freezer. That's an example of friction, making it harder to take action. What would that be in an investment context? That would be, as we talked about before, setting, I can only change it once a year, right? Or I tell my advisor, only make changes after 3 days. Each of these are ways to slow you down. Externalize and slow down. Those are the two best techniques that I know of.
So we've been covering and attending a lot of investor conferences last couple of years in India. I've personally been to many of them, and I figured that eagerness to learn more about behavioral sciences, to improve your own behavior as an individual investor, is only growing here in India. And a lot of viewers of ours, I'm sure, are also very keen to read more and to become more knowledgeable about this subject. So if you were to recommend a couple of books which have been instrumental in shaping your own psychology on our behavior towards investing, what would those books be?
Sure. First book absolutely would be Thinking Fast and Slow by Nobel laureate Danny Kahneman. Excellent book, an overview of the field. Now, if you look particularly in finance, there's a nice book on, I don't have the name exactly right, the stupid mistakes that smart people make with money. Gilovich, I believe, is one of the authors. Great book. It's been in press for like 20 years, not quite that long, but in many editions. It's wonderful. There's also a nice summary of particularly the investment challenges. The Laws of Wealth by Daniel Crosby is also a nice book. That's a more recent one as well.
All right, Steve, wonderful chatting with you. Thank you so much for your time. I'm sure the inputs which you provided will help our viewers and investors out there to become better investors. Thank you very much for your time.
Thank you so much for having me.
Guys, with that, it's back to you.